I want to say something about investment returns in the 2020 USS valuation and why I think there's a bit of an issue here with how low these returns are and how that relates to the level of prudence that's being assumed by the trustee. So this is a page on the screen here from the 2020 technical provisions document that was circulated to employers. You can find it on the USS employers website, probably on USS's website as well. And it's a table which shows the possible figures that are going to be used for investment returns in the valuation and the effect it has on things like the deficit and stuff like that. Now, there's a little bit of explaining to do to understand what's going on here. Firstly, in this valuation, USS have not yet decided whether they're using a strong covenant rating or a tending to strong covenant rating. And that's partly because of ongoing discussions with employers over whether they will sign up to measures to lock themselves into the scheme. So USS in this document have given two different bases for the valuation, and I will explain more about that in a minute. There are also other complications to do with what's called the discount rate in the valuation. This is the discount rate is essentially the returns you are assuming on your investments, but because of some advice from the joint expert panel, the discount rate is presented as what's called a dual discount rate. So that involves two separate rates that are combined together in a way that I'll also explain later. But what I just want you to focus on at the moment is the bottom line of this table, or perhaps the bottom two rows of this table, which show what's called a single equivalent discount rate. So that's where you take your dual discount rate and turn it into a single rate, in other words, a single proposed modelling of investment returns for the future. And there are four columns here, so it's shown on two different bases in four different scenarios. Okay, so I will try and explain what's going on. So in the left-hand column, this is the tending to strong covenant rating, and the single equivalent discount rate that USS are proposing to use in that case is shown as gilts plus 1.4%. Now what this means is that they will assume in this situation that returns will be 1.4% above what they would get if they invested solely in long-dated government bonds, which are also known as gilts. Okay, so that's one way of expressing this discount rate. The other way is to say that the discount rate they're assuming is equivalent to CPI plus 0%. In other words, that their assumption on the tending to strong rating is that they won't get any real growth in their investments. Just match inflation is the best they can do. Now this looks like a really low rate. It struck everyone who first saw this document as an extremely low rate to assume for investment returns. Compared to history, it's extremely low, and we'll look at why this might be so low. That's, I guess, the purpose of this talk. The other column I'd like you to focus on is the final column, which is, if you like, the best case that USS are proposing to entertain, and that is where there's a strong covenant rating and the most optimistic view that the trustee says they're prepared to accept, which is that investments will return gilts plus 1.9% over the next 30 years. And that's, they say, equivalent to a return of CPI plus 0.5%. So this is 0.5% real growth, which again is very low compared to historical growth. Okay, so again, I want to investigate why this figure that they've arrived at, the CPI plus 0.5%, is so low. And so I've done a bit of analysis, which I'm going to explain in this video, and I think there are some slightly dubious reasons why they've ended up with such a low rate here. Okay, and I don't think you particularly need to look at the deficit column, but of course, the deficit row, sorry, but of course there are some scary figures going on here. Right, so let me focus a bit more in on the dual discount rate, and here's another page from the same document. And this table shows how you arrive at the discount rates that were shown on the previous slide. So in fact, let me just go back and just point to a number just to make this really clear. This gilts plus 1.9% single equivalent discount rate in this table is made up from a rate of gilts plus 3.5% for what's called the pre-retirement portfolio, and gilts plus 1%, so that's the gilts plus 3.5% here, and the gilts plus 1%, which is for what they're calling the post-retirement portfolio. If you combine them together in a way that makes sense for the valuation, it works out as gilts plus 1.9% as a single equivalent. So with that, and before I move back to the other slide, here's the tending to strong case and a pre-retirement rate of gilts plus 2%, combining with a post-retirement rate of gilts plus 1% makes gilts plus 1.4%, according to USS. All right, so back to this next table, and you can see the same numbers occurring here. So if you like, these first two columns are the strong covenant case, and the final two columns are the tending to strong case. Here we have that 3.5%. This should be interpreted as gilts plus 3.5%. Above the table it says all rates are on a gilts plus basis, combining with a post-retirement rate of gilts plus 1%. And likewise for tending to strong, pre-retirement gilts plus 2, post-retirement gilts plus 1. But the interesting thing about this table is what it tells us about the so-called confidence levels, or the centiles that are being used for these assumptions. Because these discount rates that are shown here are prudently adjusted discount rates. What does that mean? Well, let's take this first column. So this is where USS are prepared to rate the covenant for the scheme as strong, and they say that a portfolio that they're calling their pre-retirement portfolio, under those circumstances, and this is the assets held in respect of people who are not yet retired, who are still active members in the scheme, or perhaps deferred members in the scheme, and they're saying that the best guess at how much that portfolio will return is 5.9% above gilts. Gilts plus 5.9%. Now that best estimate or best guess is the median guess. In other words, it means that half of the time USS expect to be able to do better than gilts plus 5.9% on their portfolio, and half the time they expect they will do worse. Okay. Right, but that isn't the rate that's being used in the valuation, because legislation says you do have to prudently carry out the valuation prudently, which most trustees interpret to mean that they should downplay their investment return assumptions. So what USS have done is turn that 5.9% and squashed it down to 3.5%. So that's the rate that they think they will get on their pre-retirement portfolio. Now, underneath these numbers is some modelling that USS does using some software that they've got, which predicts the future in some way and gives you what's called a distribution of investment returns. So bang in the middle of their distribution is the 5.9%, but then somewhere further along the distribution is this gilts plus 3.5%. And in fact, they tell us that this has a confidence level of 78%. In other words, according to their modelling, 78% of the time they will get a rate of gilts plus 3.5% or better from this portfolio, and the remaining 22% of the time they will do worse. Okay, now this is it's relatively standard to adjust for prudence in this way, to take a centile that's lower than what's called the 50th centile, the median, the middle guess, and move it, make it more prudent. So we've gone from the 50th centile up to the 78th centile here. But the thing that isn't so standard is the fact that USS have moved this from previous valuations. In previous valuations, they were perfectly happy to use what's called the 67th centile. In other words, that's so at the 67th centile, you would get the rate that you would expect to achieve or better 2/3 of the time, and a rate that you would it would be a rate that you would expect to underperform on 1/3 of the time. But USS have decided in this valuation to up the confidence level to make it safer, if you like. Now, their reasons for this are I don't find completely compelling. They talk about pandemic and the like, but I don't want to dwell on this point too much. That's not really the purpose of this talk, but one would expect that the underlying distribution would become wider if there's uncertainty due to the pandemic, not that you would move your confidence level. That seems to me to be a dubious way to deal with the pandemic. Nevertheless, that's what they're proposing, and as I said, it's not predominantly the focus of this talk. So if I look at some of the other columns, the post-retirement portfolio, so this column, the second column here, corresponds to the returns expected on the post-retirement portfolio in respect, so that's the assets held in respect of people who've retired and are already claiming benefits, and that's what's often referred to as a safer portfolio of assets. It's roughly speaking, the argument is that you would like predictability over the returns on those investments, so you go for corporate bonds and the like, and government bonds. You get a lower return, but a more predictable return is the argument. I'm not going to, again, talk about the merits or otherwise of that argument. But here, the gilts plus 1% we saw on the previous page features, but the best estimate, the 50% of the time USS think they could get gilts plus 1.55%. The gilts plus 1% corresponds to a 73% confidence level. Again, a higher confidence level than the 67% used in previous valuations. The final two columns are the same information but for the tending to strong portfolio, and there you see the gilts plus 2% is all the way up at that 85% confidence level, way above the 67% confidence level. And then finally, the gilts plus 1% matches up with the post-retirement portfolio. The post-retirement portfolio is the same in both cases, and we're looking at gilts plus 1%, which is the 73rd centile. Now, so already there's something that needs a bit of explaining, which is why is it appropriate to move the confidence level for this valuation? There's certainly an argument to be had there. As I said, I don't find the reasons particularly compelling, and it looks a little bit like, in fact it looks quite a lot like, fixing the confidence level to get the discount rate you want, rather than what I would see as a more honest approach to valuation, which is decide on your confidence level and discover the appropriate discount rate. Okay, but nevertheless, that's not the purpose of this talk. The purpose of this talk is to focus on some figures we were provided by USS on the JNC, which are not confidential. I will make them available in the link under this talk. And this is comparisons of returns on various portfolios at various dates. Okay, this is something we asked for because we wanted to understand what was going on. So the three dates in question are the 31st of December 2019, 31st of March 2020, and 30th of June 2020. And in each case, there are three different portfolios that numbers relate to here. One is the pre-retirement portfolio in the case of a strong covenant. One is the pre-retirement portfolio in the case of a tending to strong covenant. And the final one is the post-retirement portfolio, which is the same in both cases. Now, there are two columns at each date. One showing rates on a gilts plus basis, and one showing rates on a CPI plus basis. So this is the same as we've already seen. One column of figures for each date shows how much more USS are expecting to achieve than if they invested in gilts, and the other is showing how much more USS are expecting to get from their investments compared to inflation. Okay, so why are these figures interesting and what have I discovered? Well, let's just look at the 31st of March figures here. Those are the ones that I've focused on. Now, if I just focus attention on the pre-retirement strong portfolio, you will see there are three rows given in this table. One is the best estimate. So, and again, you'll recognise the 5.9% figure on the gilts plus basis here. So gilts plus 5.9% is the best estimate for the pre-retirement portfolio in the strong covenant case, and that matches up with the previous document. But we're also given other centiles here, and confusingly USS have switched their convention. They're now talking about the 33rd centile, where they previously would have talked about a 67% confidence level. 67 plus 33 is 100, of course, so they're kind of viewing things in the reverse direction. And the 25th centile, where it would have referred to a 75% confidence level. Now, they don't show the rows precisely corresponding to the discount rates we saw, but remember what they were calling the 78% confidence level, which would be the 22nd centile, so that would appear somewhere underneath this row. They said they would get gilts plus 3.5% on the pre-retirement strong portfolio. And that number does fit nicely with the trend of numbers here. Okay, but we also have numbers on a CPI plus basis, which we haven't seen before for the individual portfolios. And that was the interesting bit. So what I did was I took these numbers, put them into an Excel spreadsheet, and then tried to so the first thing I did was fitted a normal distribution for the 31st of March figures in each case, so as to be able to get at any centile I wanted as an approximation. So let me show you my spreadsheet, which looks like this, and apologies, these numbers are a bit smaller because there are more of them, so I hope they're just about readable, but I will try not to rely too much on you being able to see what's written here. But the 31st of March data are the middle, are the rows that I'm highlighting here. And the column labelled gilts here and the column labelled CPI here contain numbers directly from the document. So there's that gilts plus 5.9% figure again. And I've also added in a row here for the 22nd centile and typed in the 3.5%, which comes from the technical provisions document, gilts plus 3.5%. At the 22nd centile. But the bit that's new are the columns labelled normal approximation. So this column is a normal approximation for the gilts plus figures, and this column is a normal approximation for the CPI plus figures. So for those who aren't that comfortable with statistics, the normal curve is this bell-shaped curve that occurs in many statistical applications. You often find it's a good match for a data set. Certainly one such as the distributions underlying these returns here. At least on the downside, what's called the downside of the curve, it fits well. And what we're seeing here, so the normal approximation, for example, for the gilts plus numbers, I've taken the mean to match the middle number here, 5.9%, and I've chosen a standard deviation which matches at the 25th centile. And then the rest of the numbers here are all generated from that normal distribution. But you will see a close fit. There's the 33rd centile matches up nicely. The 22nd centile matches up nicely. The bit that I can't verify is I've got the 10th centile here. But based on the close fit elsewhere, I would expect that wouldn't be a huge distance off the true number that USS would provide. And I've done a similar thing for the CPI plus numbers here. Normal approximation with standard mean and standard deviation as shown. And again, we get a close match for the numbers that are given, but I've extended it down to the 22nd and 10th centile, and I'm hoping those numbers are about accurate. Okay, now, the first thing I want to go back to is one of the first things I showed you. Let me get the slide back up, which was on a tending to strong covenant case, USS are saying that the discount rate they're using is equivalent to CPI plus 0% and gilts plus 1.4%. Okay, but in particular, it's equivalent to CPI plus 0%, so no real growth, which is the number that hit a lot of us as extremely prudent. Okay, so if I go back to my spreadsheet, let's just examine those CPI plus rates for the pre-retirement tending to strong portfolio. Now remember, USS had said that they were using the 85th centile for the pre-retirement discount rate in tending to strong, and that's where their gilts plus 2% figure came from. And they were using the 85% confidence level, which is the 15th centile on this sheet. And then also they were using the 73rd percent confidence level, in other words, the 27th centile on this sheet for the post-retirement discount rate. So we have the gilts plus 2% for the first and gilts plus 1% for the latter. Okay, fine. And if you combine those according to the kind of weighting of the portfolio, you would end up at gilts plus 1.4% is the claim that USS made. And so I've kind of managed to match that up with a reasonable looking assumption. The interesting thing is what happens if you look at the CPI plus discount rates. So at the 85% confidence level, or the 15th centile, their pre-retirement portfolio is expected to return 0.71% above CPI, so CPI plus 0.71%. Right, okay, that's if this normal distribution is a good fit, which I expect it to be. Also, at the 27th centile, or the 73% confidence level if you like, their post-retirement portfolio is expected to return 0.32% if my numbers are approximately right, which I think they will be. Now, it doesn't take much to realise that something funny is going on here, because if you combine a portfolio that's returning 0.71% in a certain proportion, so some of your assets are going to return 0.71% above CPI, and a portfolio that's going to return 0.32% above CPI, you would struggle to come to the conclusion that your overall portfolio would return 0% above CPI, because in both cases you have got an excess over CPI. And yet that's what appears in USS's document. So something funny is going on here. Now, I don't think there's any errors in the numbers. That's the first thing to say. I think all these numbers are likely to be correct. But I think there's a subtlety that's going on that means that the prudence, if you view the discount rate that's being used in the valuation on a CPI plus basis, as opposed to a gilts plus basis, is much higher than the numbers that were being shown in the technical provisions document. In fact, at the bottom of this spreadsheet, I've tried to work out something that might give the CPI plus 0% on a CPI plus basis, and I reckon that probably corresponds to the 90% confidence level. In other words, the 10th centile, which is a long way off the 67th centile, which USS always claimed they used in previous valuations, and higher than the centiles that are shown in the technical provisions document of 85% and 73%. Right, so I think this is misleading. I also wonder whether the board even understand that this is what they've done. I don't think they do, is my best analysis of what's going on based on discussions we've had with members of the board. I don't think that anyone understands properly what's gone on here. In other words, and one other thing that's relevant, let me just show you something from the Joint Expert Panel's report, page 66 of the report. There's a footnote which discusses whether USS work on a gilts plus or a CPI plus basis. The panel asked for some numbers from USS, and the footnote here says they asked for them to be on a gilts plus basis rather than a CPI plus basis, which they claim is the trustee's default. In other words, according to JEP, they believed that the trustee worked on a CPI plus basis rather than a gilts plus basis. And this isn't surprising, because USS often make claims like this. They're not a gilts plus organisation, even though they convert their discount rates into gilts plus at the last stage. Now, I think the numbers that I've shown you already show that that is false, that they do work on a gilts plus basis, that they determine their prudence on a gilts plus basis and convert at the end to CPI plus, and in doing so end up with a much more prudent rate than perhaps even they believe that they've got. Okay, and there's another bit of the Joint Expert Panel's report, just a page or two later, where they recommend that at least in the pre-retirement case, USS should work on a CPI plus basis. Now, if they had, we wouldn't be having this conversation today. Right, let me go back to the spreadsheet again and talk about the strong portfolio as well. And again, we come to a sort of similar conclusion that the prudence on the strong basis, on a CPI plus basis in the strong case, where USS were claiming a single equivalent discount rate of CPI plus 0.5%, again, that's at a more prudent level. So on my estimates, and these are only estimates, we need the proper figures from USS. But I think that we're looking at more like an 85% confidence level on a strong basis, which again is a long way from the 67th centile, 67% confidence level. And I also calculated what I think is probably the CPI plus discount rate at the confidence levels stated in the document. And I think on a tending to strong basis, they should be using CPI plus 0.5%. And on a strong basis, they should be using CPI plus 0.9%, which are much higher discount rates. It doesn't sound like much, but those kind of figures have a big effect on the valuation. Already going from CPI plus 0 to CPI plus 0.5 pretty much halved the deficit. Of course, one of these corresponded to a 9 billion deficit, and another more like 18 billion. So that pretty much halved the deficit. Going to 0.9% would pretty much get rid of the deficit, I would guess. But I haven't done the calculations. That's just a guess. It wouldn't totally eliminate it. But interestingly, if you look at the 67th centile, which is what USS used to use, you're looking at rates of more like CPI plus 1% or CPI plus 1.3% according to my analysis. And those would certainly wipe the deficit, I would say. So, serious questions to be asked here about USS's processes on deciding on prudence and how that factors into the underlying discount rates. Now, I haven't explained why this effect occurs. I said I don't think there are any errors in the figures. I may try and record another video with some thoughts on why this is happening. Roughly speaking, you can see that the standard deviation for the CPI plus figures is lower than the standard deviation for the gilts plus figures in all cases. In other words, the spread of numbers that come out of the modelling for the expected returns compared to inflation is a tighter spread. It's not as wide as on the gilts plus basis. In other words, there's more certainty over the returns that you would achieve relative to inflation than relative to gilts. Now, because of that, if you look at any given centile for each distribution, you will find you're a different distance away from the best estimate. So what I think is going on is something like, by working on a gilts plus basis and choosing the centiles there, they end up a certain distance away from their best guess, and when they factor that figure into the valuation, if you're working on a gilts plus basis, you've gone further away from your best guess on a CPI plus basis than you otherwise would have done if you worked on CPI plus throughout. So if I do manage to record another video, I've got quite a nice sort of toy example with making simplifying assumptions to show how this effect, I think, comes about. Okay, so I'm going to leave it there. I hope that was interesting to you. I do think that there are questions to be answered here. Oh, by the way, why have I resorted to approximations here? Well, because back in November, early November, we asked USS, we spotted this kind of thing going on and asked USS for the kind of numbers that I've had to derive in this spreadsheet. And as a lot of you will be unsurprised to hear, USS haven't given us the numbers. Now, partly that might be a delay in them working that out. There's also an issue, which is another serious issue as far as I'm concerned, which is that USS are refusing to give certain information about the valuation to UCU until UCU sign what's called a hold harmless letter, which would waive certain rights to hold USS to account over that data. So there's a bit of a standoff there. The legal advice within UCU has been not to sign that letter in its current form. So, more bad stuff going on within USS, I'm afraid, and dubious stuff. If you are concerned about this, there is a letter currently circulating which has been drafted by a scheme member in Bristol who has prepared a complaint to USS about their valuation processes and about the lack of clarity and consistency in their documentation. You should be able to find that letter. That complaint will be submitted at some point soon. So do sign if you agree with what's in that letter and that complaint. Okay, I will stop there, and I wish you all the best with whatever it is you're up to in this pandemic.